Welcome back. You're watching The Money Show on ET now. We were just having a very interesting conversation with Mr. PV Subramaniam of subramani.com on mid-cap and small-cap funds. The indices, of course, have not done as well as the Nifty and the Sensex have done. They're definitely in the positive. They've definitely given at least more than 20% returns so far this year. But yeah, it's not been as great as the journey that the Nifty and the Sensex has seen in the year 2020. But there have been funds that have managed to beat the indices, their benchmarks through and through. One such fund is that of the BOI AXA Small Cap Fund. Compared to the benchmark, in their case, the benchmark is the Nifty Smallcap 100. The BOI AXA Small Cap Fund has managed to deliver close to 50% in terms of returns for its unit holders in the last one odd year, whereas the benchmark has given about 20%. So it's a massive alpha delivered. Let's meet the man behind this alpha in our Meet Your Fund Manager segment, Mr. Ajay Khandelwal. He's a fund manager for equity with BOI AXA Investment Managers. Ajay, thank you so much for joining us today on ET Now. And, kudos to you and your team. Congratulations on the great performance you witnessed. A brief glance at your fact sheet shows that you've put your money, or you've put the fund's money in some very niche sectors, specialized sectors. But before I delve a little more into, the constituents of essentially the portfolio, let's first start off by what's been your strategy and what sort of aided you in this outperformance. And I think yours is relatively a newer fund as well.
Thanks, Pravina, for inviting me on the show. So our fund now is actually a 2-year-old fund. It was launched in December 2018. And during this time, we have outperformed our index by almost 40%. So the strategy behind our performance, and which is strategy we usually deploy across our schemes, it is two-part strategy. We focus on identifying high-quality companies, and we invest only in high-quality companies. And second is we try to identify industries where business environment is improving, and that can lead to earning acceleration. So these are two primary strategies which we have followed over the course of 2-3 years. During this time, we have seen the ILFS issue. We have seen the COVID impact. But based on these two strategies, we have been able to identify industries which have benefited even during these times. We have been able to identify companies which have performed well during these times. So if you look at our portfolio, you will find we have these industry leaders. We have these companies which where the balance sheet hygiene is very good. The cash flow generation is strong. They are scalable businesses. The management quality is very good. So all these things we have, even when we have delivered this performance, we have not actually compromised on quality.
All right. A major chunk of the fund is in chemicals. Usually when you open a mutual fund's fact sheet, a majority is in banking and financials, because that's also got a major weightage in the market. So what's lending you conviction on this sort of a niche space that makes you believe that it could perhaps continue taking the NAV as well of this mutual fund for unit holders higher?
Yes. So if you look at our exposure to different sectors, as I said, we look for sectors which have higher growth visibility, where quality of earning is not compromised just to get the growth. Now, chemical sector is a vast sector. There are so many segments, sub-segments in this sector. Our focus is on companies which cater primarily to FMCG industry, pharma industry, agrichem industry, where the end user demand is fairly predictable. So these companies, they have gained market share during these times. They have improved on their product portfolio, and that has led to the earning growth. Now, regarding why this will continue to perform and why we are bullish on this sector is, so if you look at specialty chemical, the addressable market, relevant addressable market would be around 40 to 45 billion dollars, and over course of 5 years it can double. So that will deliver around 14-15% kind of growth. These companies, if you look at the total market share of global exports for chemical companies, is barely 2 to 5%, whereas that for China is between 12 to 20%. So when supply chains are moving away from China, we are seeing that customers are looking for various suppliers. We believe that these companies, the kind of effort they have put in over course of last 5-10 years, where they have worked on improving their products, where they have worked on meeting all environmental regulations. So they've invested a lot, and that is now giving the returns. So we believe these companies are poised to gain more market share, and this growth again would be very healthy. These are a couple of things about chemicals. And also I would like to add here that the quality of management in chemical companies is the best, among the best. The kind of surprises they've been able to deliver over the course of last few years, they've been able to enter into new industries. They have been getting larger ticket size business from existing clients. So all these things, the journey would continue for, we believe this journey will continue for next 5-10 years, and chemical sector will continue to provide a lot of interesting investment opportunities.
Okay, a very interesting note. Many of these, or in fact all of these chemical companies do have great quality management, experienced management as well. You know, many unit holders, and this is what we've been noticing, you know, recently, Ajay, that you know, with the Nifty and the Sensex rallying, many unit holders have been sort of, and this is again what mutual fund companies do tell us, that they are looking at this rally as an opportunity to book some profits, and that's the reason why, you know, the last couple of months we've been seeing a lot of redemption. A lot of unit holders are redeeming. So, you know, what would be your advice to these unit holders? I mean, it could be quite tempting, right? That, okay, you know, BOI AXA Small Cap Fund has given 50% return when, you know, the rest of the market has struggled, so I might as well just redeem. What would be your advice, you know, to these unit holders?
See, that it is actually a function of the investment, the horizon of the investor. They have to understand that if they are redeeming just because the fund has gone up, then it will be difficult for them to re-enter the market if market continues to move up. But if they are rebalancing their portfolio because of their investment needs, then it should be fine. My advice to investors is that if they feel that the scheme has given 50% return and they are redeeming, then they should consider that small cap indices are still, I think during 2018, the peak market cap for small cap put together was around 20 lakh crore, which is barely 16.5 lakh crores now. If I look at valuations, the 1 year valuation is still below one standard deviation, below mean valuations. During, I think 2018, the small cap to Nifty ratio was around 0.9, which is still 0.65, 0.7 reaching. So small cap has got a lot of steam left. This is from the perspective of valuations. But personally, I feel small cap investing should be encouraged, because as a fund manager, we can find a lot of opportunities. And that is what makes us more bullish. There are so many industries which are good quality industries, which meet all our requirements, meet all our parameters, and we see growth returning into these industries. So if the operating performance of these industries will continue to do well, small caps will also continue, they will continue to perform. So I would suggest investors not to be short-sighted and just because a fund has performed and they start redeeming, because this is they should be treated as a long-term money, and then only the rewards will be eventually come to them if they invest more, if they keep money for a longer period.
All right, let's talk about risk. We often say that mid caps and small caps are a little bit more volatile than a large cap fund. So would you say that, those investors who do have the appetite to take on board a little more risk are the ones who should invest in this fund? And to what extent would you believe that this fund would be okay for even the relatively more conservative investors?
So, see, risk and return go hand in hand. Now, small caps, they are perceived to be having higher risk, which is to an extent true also because these businesses have smaller balance sheet, they have higher dependency on few customers. So during trouble time, they find it difficult to have access to capital. Their bargaining power with suppliers and clients go down. So typically working capital stretches. But these are the things that small cap companies have to deal with. On the other side, the earning growth profile is typically higher for small cap companies. So as my advice to investors is they have to look at the portfolio of a fund. They have to understand that the portfolio construct should reflect industries where there are tailwinds, where the operating environment is healthy. And long-term investors, they ideally should have higher capital allocation to small cap funds. The growth-oriented investors should have higher allocation to small cap funds. See, we never had the kind of small cap companies available to us maybe 3 to 5 years ago. Now, because these new businesses which got listed in recent time, we have now access to all these companies which meet our investment criteria. They are delivering growth. The growth longevity is also high. So small caps will continue to do well. My advice is investors should have at least medium-term investment horizon, and they will be aptly rewarded by investing in small cap funds.
Okay. Ajay, many thanks for joining us today on ET Now. And all the very best. I'm sure you've got many very exciting times going forward as well, as we at ET Now as well have been speaking about how the best of India is yet to come, and I'm sure fund managers like yourself are trying to constantly spot these opportunities. All right, well, on that note, we will take a very short break right here on The Money Show. Don't go anywhere.